Hello traders, so welcome back to the Compare and Contrast series. So if you have not yet watched the session just before this one, comparing and contrasting, owning what I am here, long stock, and then selling a call against it, commonly known as a covered call. If you have not watched that session, I might suggest you go watch it first, because we're we compared and contrasted owning long stock alone by owning long stock and then selling a call against it. Now, if you already own 100 shares of some stock that is an optionable stock, you already have the ability to do this in most accounts, including IRA accounts, etc. This is one of the safest options trades out there, and the reason I say it's one of the safest is there's no risk of loss. There's only upside to this. Now, let me just put the caveat on there. So what I mean by that is if you're going to own 100 shares, in this case, if you're going to own 100 shares of SPY anyway, you've already made that decision that you know you're going to own 100 shares of SPY or 100 shares of Johnson & Johnson or Microsoft or Kroger or Coca-Cola or whatever it is. You're already committed to owning that position. Again, most people do this in like an IRA or some sort of a company 401k account or whatever. And you have at least 100 shares of it, then selling this covered call gives you zero additional risk. In fact, it reduces your overall risk in the position by a minimal amount each time you sell this covered call. Again, if you're not sure what I'm saying right now, please go watch that prior video that's about 20 minutes long, and that will help shed some light on that. Now, what I want to compare and contrast to today is something called a poor man's covered call. So what if I like this conceptually? I like the fact that I can rent out my stock, is the way I described it, and bring in some additional income every time I do this. So if I like this conceptually, but I don't have $44,000 to go out and buy 100 shares of SPY, is there an alternate way that I can do something like this? And the answer to the question is yes. It is called a poor man's covered call. So why is it called a poor man's covered call? What does that mean? Well, it means that I can substitute my 100 shares of stock, and instead of 100 shares of stock, I can go out and buy what's called a leap. That's a long option. A long option or a leap is usually defined as something that's not going to expire for more than a year out in the future. So this is a call. In this particular case, I'm using one that is January of 2025. So that is 1.4 years away is when this long call expires. Now, for the sake of my purposes today, I'm looking at buying essentially an at-the-money call. SPY is currently trading at $444. I'm buying a $445 long call. I'm buying that out again in January of 2025. Now, when I buy that long call, I'm going to spend $5,250 to buy that long call. Now think about this a second, because on the left side over here, I am spending $44,000 to buy 100 shares of SPY stock. Well, geez, for almost a tenth of the price, I can have similar, not the same, similar characteristics. In other words, if SPY goes up, my long call goes up in value. Over here, if SPY goes up, my long call goes up, or excuse me, my underlying value of my position, my stock, it goes up in value. So very, very similar profile from that standpoint. So forget the covered call right now. Again, we sold the covered call over here that did cap the amount of money we can potentially make for the month or so out that we sold this. It looks like we sold this 39 days out. So we did put a cap on that. That's what the trade-off we were willing to make. We were willing to go ahead and take in this case, $328 for selling this 39 days out from today, because we don't think SPY will be above 455 39 days from today. That's the premise that you need to kind of have in your mind if you're going to do this. And in exchange for that, if SPY does go up to 460, 465, we're not going to participate in that part of the gain. So that's the trade-off that we've made in order to collect that $320 some. Now, again, let's just remove this for just a second, and we'll just exclude that. So if we look at it right here, this has a similar profit profile, the stock, to our long call. However, a couple differences we need to keep in mind. Stock does not decay. If we come and we look at theta, there's going to be zero theta in stock. Stock does not decay over time. Options do, because they have a timestamp, an expiration date on them. They're not good beyond a certain date. So, in exchange for we're not going to spend $44,000, we're only going to spend $5,000. However, we have to recognize, and some of you may not see all these stats here if you're on the starter version or the free version of optionstrat, you won't have this information, but this is good critical information to have. So you may very well want to consider upgrading to a level that provides this. If you're going to be an options trader, this is information you're going to need to have. So in this particular case, buying this 445 call, I'm going to spend $5,250 to buy that, and that is going to decay at the rate of $6 a day. Okay, now this is a theoretical number. It's not like it's $6 every single day, and it does accelerate the closer you get to expiration as well. So that's fine and dandy, because if I think that SPY is going to just rip, okay, maybe I'm okay with that, because it's worth it for me if this thing is going to rip up. And another one you might want to go look at, Avgo. So Avgo, or Broadcom is the company name. And I think I did this with FedEx as well. I think I've shared some examples. So I felt that Avgo and FedEx were a couple stocks that were going to rip after they sold off after an earnings report. So I bought long calls just like this. And the stock has ripped up from there, and I have 300, 400% profits in some of those positions because rather than buying, Avgo is trading at $700 or $800. Rather than spending $70,000 on Avgo, I think I spent $9,000 on Avgo, and that position's now worth about $40,000. So again, that's a slight deviation here. You don't have to cap your profitability here if you think this thing is going to rip up. But the position I want to share with you today is the poor man's covered call. So we buy the leap, the long call, at $445 all the way out in January or some point in the future. You determine a point that you like. And now we know that that amount that we spent on that $5,250 is going to decay. So we really want SPY to start moving up here fairly quickly. But if it does not, how can I offset that money, that theta decay on a daily basis? How might I take in some additional money or generate some juice, if you will, off of this position? So let me just come in, include this again, and that should give you a clue. We're going to include it over here too, and you'll see what happens. So in this particular case, this creates something called a calendar. I don't want you to really worry about that right now. A calendar is a totally different type of position. It is a pretty advanced position. But that's what a poor man's covered call creates. It creates this sort of a P&L diagram But don't get lost in the fact that it's a calendar. All you really need to look at is the fact that I had this position that I had paid $45,000 for, $2,500 for, and now I've sold a closer call. In this case, I've sold a September 22nd call against this. I've brought in $329 to do that, and that basically reduces my cost in this trade. It also turns me theta positive. So now, rather than this trade costing me on average about $6 a day to hold, the fact that I have sold this is bringing in daily decay that is offsetting that $6.50. So let me just turn this back off a second. Let me just exclude this. Again, now here we're at, I said 2,500. We're at 5,250 in risk. But when we sell this, that reduces that risk to 4,800 because of the $320 or whatever we took in here. Now, let's just say a little time goes by here. Let's just say that, 3 out of the 4 weeks where I sold this go by and we're not at 455. Well, I just simply close this and I go and sell another one out I tend to do 30 to 90 days personally, just because I'm not as active in these. And I bring in another $330, and then I do it again and again. And if I do that for the entire year, it's not at all out of the question that I can greatly reduce my risk in this trade and essentially bring in monthly income based off of my original investment of that $250 it cost to buy that long call position. So I know I'm going a little deep here, and if you don't fully get this, don't worry about it. It's just a way that people, if you don't have the $44,000 to buy the stock, first of all, you can certainly do this with a less expensive stock. Look for stocks that are trading, stocks that you want to own. You don't just get into a stock so you can sell a covered call on it. Look at stocks that you want to own long term, and once you find those and get into those stocks, then you can look at selling covered calls. Now, I might also mention on this that by owning the stock, I'm also getting a dividend off of this stock. I will not get a dividend by owning the long call. So in some cases, stocks produce enough revenue in dividend that I want to own the stock itself. I don't necessarily want to do the covered call, don't want to necessarily do the poor man's covered call on that. Because of the what the stock brings in dividends too. But also I should point out that let's just say I have a stock that pays a 4 or 5% dividend, like maybe a Johnson & Johnson. Well, not only am I getting a 4 to 5% a year dividend, but if I'm selling a covered call against that, I'm bringing in an extra 4, 5, 6, 10% a year. So not only am I getting dividends, but I'm getting this extra juice from the covered call. So again, this is owning the stock and selling a covered call against my stock position. The poor man's covered call, I've got a lot less money invested in this, but I'm not going to get dividends in this case. But I can still sell this call, this short call, against my long call position that's much, much further out, and it's kind of acting like a stock, a pseudo stock for me, but it is costing me theta to hold it. So hopefully that made a little bit of sense. I know it went a little deep. Maybe play it back a time or two. I'm going to put some notes down in the description too that might help further explain this, so look for those also. And then also go look at the Google wheel strategy video, and I talk about the wheel in there where we talk exactly about this. We talk not only about selling the covered call. Once we ever get assigned, we still haven't gotten assigned. We've rolled short puts twice now. So we've reduced, when we do get assigned Google eventually, we've reduced our cost basis by about $5 a share already, and we may be able to roll that 2-3 more times, so that when we ever do get assigned Google, we're already going to have, you know, maybe $1,000 or more in profit built into it, more than $10 a share. So we will have reduced our cost basis in that stock. So I'm going to wrap it up here at this point. Again, please like, subscribe. That helps me a lot. Put any comments down there. I try to get to those comments as well. And take care, everyone.